The question is, does Walmart take out life insurance like we're taking out this Chesapeake Bay trash on their employees without them knowing? I'm not sure if there's some creators out there who've brought this story into the current social conversation. If the answer is today, no, Walmart does not do this practice anymore, but this was true at one point. Here's the real story of corporate-owned life insurance. You see, back in the 80s and 90s, corporations started taking out life insurance plans on their employees in large numbers. Now, commonly practiced in the business world is mitigating your risk for key employees, or funneling employee income through life insurance for tax advantages. These are most often done through specially designed policies like Section 162 Executive Bonus Plan, non-qualified deferred compensation plans, and key employee life insurance. Now, the intent of those plans, like I said, is to mitigate the risk to the company if they were to lose one of their top producing employees, or funnel income to an employee in a tax advantage way that allows the company to avoid going over IRS excess compensation regulations and lets the employee defer income taxes. But companies quickly realized they could also use the tax-free growth that accumulated in these policies to fund their own operations, and at the time they could actually deduct the interest payments that were due on those loans. And then later, of course, if the employee actually passed away, they get a nice tax-free death benefit. So during this time period in America, there was no actual laws or regulations that mandated that an employee had to be notified the company was taking out a policy on the employee. Now, in Walmart's specific case, they actually did notify their employees, but they did so in a very shady way. They actually would offer them a very small amount of death benefit as free life insurance, like $5,000 or $10,000 worth, and would fail to notify the employee that they were actually taking out a much larger policy, several $100,000 worth, with which they would be the beneficiary of. But technically, the employee did provide consent, they just didn't fully know what they were consenting to. Now, fast forward to today's age, and 48 out of the 50 states in America have outlawed this practice of not providing notification to the employee and getting their authorization to put a plan in place. And in the 2 states that don't have laws mandating this, the IRS will actually penalize and tax the death benefit if shown that the employee never consented to the policy. They also stopped allowing companies to deduct the interest payments due on policy loans. And a taxable death benefit completely undermines the advantage of doing this practice in the first place. So suffice to say, in today's world, no companies are really doing this practice anymore. I think this story seems the more plain to the current climate where people are starting to turn against big corporations and really finding anything they do as evil, which is a little ironic because most of us either work for a big corporation, so our money is dependent on how successful that corporation is, or like myself, own a small business and hope to grow that business one day to become a big corporation, albeit one that uses profit more for charitable action than just for profit's sake.